All right, let's talk about incentive stock options, or ISOs. Getting these can feel like you've just hit the jackpot. But, and there's always a but, right? Actually cashing in on them is a whole different ballgame. It's way more complicated than you'd think. So today we're going to break it all down. How to take that piece of paper and turn it into a real payday.
So let's just kick things off with a number that's guaranteed to make you sit up and listen. $240,000. And no, that is not a typo. This isn't some fantasy number. This is the kind of real, honest-to-goodness profit we're talking about when an ISO plan goes perfectly.
So how do you get to a number like that? Well, picture this. It's the dream scenario, right? You got 1,000 options to buy company stock at just $10 a share. Then the company just takes off. I mean, it soars. The stock price hits $250 a share. You sell? Boom, 240 grand in profit. Sounds simple enough, doesn't it?
Yeah, if only it were that easy. Here comes the reality check. The second you decide to do anything with those options, you're suddenly thrown into this maze of super complex tax rules, tricky holding periods, and big strategic choices. And trust me, one wrong move can completely change how much money you actually walk away with.
And what's the biggest, baddest monster in that maze? It's something called the Alternative Minimum Tax, or AMT for short. Seriously, this thing trips up so many people. It creates this totally bizarre and frankly frustrating situation that feels like a classic catch-22.
This quote from Cerity Partners just nails it. Here's the trap in a nutshell. You use your options to buy the stock, great, but you decide to hold on to it. Maybe you think it'll go up even more. Well, the IRS looks at your paper gain and says, hey, you owe us taxes on that, and sends you a massive bill. The problem? You haven't sold anything. You have zero cash from the stock to pay that bill. That, right there, is the AMT catch-22.
So, how do you avoid that nightmare scenario? Well, it all starts with learning the lingo. You've got to be able to read your grant agreement and actually understand what it's saying. Seriously, getting these key terms down is step one to building a smart plan.
First up, the grant date. This one's easy. It's just the official date you're given your options, but it's super important. Think of it like a starting pistol firing. This is day one, and it kicks off a very important 2-year countdown for getting the best tax treatment. We'll get into that a lot more in a bit.
Next, you've got the exercise price, sometimes called the strike price. This is your special, locked-in price to buy a share of stock. It never changes, no matter how high the stock price goes on the open market. And that gap, the difference between your low price and the high market price, that's where all your profit is hiding.
Okay, so what is that market price called? It's the fair market value, or FMV. It's just what the stock is worth today. Now that difference between the current FMV and your low exercise price, that's your paper gain, and you'll hear it called the bargain element. Remember that term? Because that is exactly what gets the attention of the dreaded AMT.
Finally, there's the vesting schedule. This is basically the timeline for when you actually earn the right to buy your shares. You don't get them all at once. A really common schedule is a 4-year plan with a 1-year cliff. What does that mean? It means you have to stay with the company for 1 full year to get anything. Then, on your first anniversary, bam! 25% of your options are yours. After that, you'll usually get a little bit more each month.
Okay, so now that we're all speaking the same language, you get to a crossroads. You've got your vested options, and now you have to make a choice. There are really 3 main strategies, 3 different paths you can go down.
So let's break down these choices. Path number 1 is the exercise and sell immediately play. This is for the risk-averse. You get your cash right away, no worries about the market crashing tomorrow. The downside? You're going to pay the highest possible tax rate, ordinary income tax. Path number 2 is the exercise and hold long-term. This is the big growth bet. You're hoping the stock goes to the moon. This has the biggest potential upside, but it's super risky. It ties up your cash, and yep, it triggers that AMT we talked about. Finally, there's the middle ground, exercise and hold for tax benefits. This is the tax-optimized play. You hold just long enough to get a lower tax rate. The upside is, well, a lower tax bill, but you still have market risk and you still have to deal with the AMT.
So that third option, the tax-optimized play, that brings us to a really critical idea. It's called dispositions. I know, it sounds like a fancy legalish word, but all it means is how and when you sell your stock. And believe me, getting this right is the key to how much you'll pay in taxes.
All right, pay attention, because this is the money slide. To get the absolute best tax rate, what you're aiming for is a qualifying disposition. Now, to qualify, you have to follow 2 simple rules.
Rule 1, you have to sell your stock more than 2 years after the grant date. And Rule 2, you also have to sell it more than 1 year after the day you exercise the options. You can't just pick one, you have to do both. I'm going to say it again. You have to satisfy both rules.
And why are we so obsessed with these rules? Look at this chart. This is why. If you mess up and have a disqualifying sale, you could pay up to 37% in taxes, just like regular income. Ouch. But if you follow the rules and get that qualifying sale, your tax rate plummets down to the long-term capital gains rate, which is way lower, like 15 to 20%. The difference here isn't just a few bucks. We're talking about a move that could save you tens, maybe even hundreds of thousands of dollars.
So now we know the goal, right? Get that qualifying disposition. But to do that, you have to exercise and hold. And that means we have to go back and face the final boss in this video game, the alternative minimum tax. It's, without a doubt, the single biggest headache when you're trying to execute this strategy.
So what even is the AMT? The simplest way to think about it is like a whole separate parallel tax system. Each year, your taxes are calculated twice, once under the regular rules and once under the AMT rules. And guess which one you have to pay? Whichever one is higher. And the whole problem is that the AMT system counts certain things as income that the regular tax system just completely ignores.
And what's the number one thing it sees? You guessed it, that bargain element we talked about earlier. Remember, that's the paper profit you have when you exercise. Under the regular tax code, nothing happens. No cash, no tax. But in the world of AMT, that paper profit is treated as cold, hard income for the year. And that's what triggers that huge, terrifying tax bill, even when you haven't seen a dime of actual cash.
Okay, deep breaths. It's not all bad news. There is a silver lining here. When you pay that AMT, you generate something called a minimum tax credit, or MTC. The best way to think of this is like a prepayment on your future taxes. It's not gone forever. When you do eventually sell the stock down the road, you can use that credit to lower the tax bill from the sale. So really, it's more of a cash flow problem than a your money is gone forever problem.
All right, we're almost there. There is just one more rule you absolutely positively have to know about, and it all revolves around this number, $100,000.
This is called the $100,000 rule, and here's what it says. In any single calendar year, only the first $100,000 worth of your options that vest or become exercisable get that special ISO tax treatment. Any options that vest in that same year above that $100,000 limit, they automatically get reclassified as a different beast called a non-qualified stock option, or NSO, which has totally different and usually less favorable tax rules. This is a big one, so make sure you track it.
Whew. Okay, I know that was a ton of information. We've learned the lingo, we've looked at the different strategies, we've stared the AMT dragon in the face. So now what? How do you take all of this and actually figure out what you should do?
And here's the thing, there is no one-size-fits-all answer. It completely depends on your personal situation. So you need to ask yourself some serious questions. How is this going to affect my tax bracket? Am I actually comfortable holding so much of one company's stock? What are my key dates, grant, vesting, expiration? Do I need this cash for something big, like a down payment? And how much of my entire net worth is tied up in this one company?
Look, at the end of the day, ISOs can be an absolutely incredible opportunity. They can be life-changing, for real. But turning that potential into actual money in your bank account takes a lot more than just good luck. It takes a plan. Having all this information is great, but having a strategy that's built just for you, that's priceless. So the only question left is, what's your move?